Something big was supposed to happen this week. The SEC, America's financial regulator, was preparing a move that could have opened one of the biggest new doors between crypto and traditional finance. A plan that would allow crypto companies to trade digital versions of real stocks like Apple, like Tesla, on the blockchain. Imagine buying a token designed to track the value of an Apple share traded on crypto platforms, available 24 hours a day, 7 days a week. That was the plan. It was called the innovation example. And according to Bloomberg reporting, it could have been released this week of May 18th. Then on May 22nd, the plan was delayed. No clear new date, no confirmation timeline, just uncertainty. And I want to break down exactly what happened, why it matters, and what it could mean for your money, because this is bigger than most people realize. So let me explain what tokenized stock actually are in plain English. Let's start. Right now, if you want to buy an Apple share, you usually go through a stockbroker, you use a traditional platform, you trade during market hours, and even though the system has become faster, it still runs through traditional markets plumbing. Tokenized stocks would try to change that. A tokenized stock is basically a digital token designed to represent or track the value of a real share. But this part is important. Depending on how the token is structured, it may not give you the exact same right as a normal shareholder. You may not get voting rights, you may not get dividends, and you may not have the same legal protection as someone holding the real stock directly. That is the one big concern. But the idea is powerful. You could potentially buy it on a crypto platform, trade it outside normal stock market hours, move it faster, settle it faster, and access traditional assets through blockchain rails. This is what the SEC was reportedly preparing to allow under its innovation exemption. And this is where Wall Street pushed back. Because think about it, if crypto platforms can offer exposure to Apple shares, Tesla shares, Microsoft shares, available 24 hours a day with faster settlement and potentially lower cost, why would investors stay only with traditional stocks exchanges? That is the question Wall Street does not want to face. So, according to reports, traditional exchanges, official and market participants raised concern with the SEC. They raised concern about investors' protection, market fairness, enforcement, shareholders' rights, and whether tokens could be created without the consent of the actual public companies behind the shares. And after that pushback, the plan was delayed. The innovation exemption, which was expected around the week of May 18th, is now on hold. No new timeline has been clearly confirmed. Now here is the part that affects crypto investors directly. After the delay became public on May 22nd, Bitcoin dropped below the mid $70,000 area, according to market reports. Coinbase shares also fell around 4.4% that day. Now, at the time of recording, Bitcoin is trading around $77,000. And depending on when you watch this, the price may have changed, but the reaction was a clear signal. When regulators create uncertainty, crypto feels it first. So what does this actually mean for you? Here's my honest take. The delay is frustrating, but it is not the end of the story. As far as we know, the SEC has not permanently cancelled the idea. They have not said tokenized stocks will never happen, and they have just slowed it down. And that tells me two things. First, tokenized stocks are coming. Maybe not today, maybe not next week, maybe not in the exact version that was being discussed, but the direction is clear. Traditional assets are moving towards blockchain rails. Stocks, bonds, funds, treasuries, real-world assets, everything is being explored. So this is not a question of if tokenization becomes important. It is a question of how regulators allow it to happen.
Tokenization could bring new risks to the global financial market, saying that automated trading and these so-called smart contracts could amplify volatility, make market shocks harder to contain. The IMF says that they want stronger regulation on tokenization and coordination globally for tokenized assets across borders. How do you do that? And do you think every market will ultimately become tokenized?
We think every market will become tokenized. Think about it. In capital market activity, almost every capital market trade occurs either in what they call T+1, T+2, T+3 settlement, sometimes longer. That means there's a lag between when the deal is struck and when it actually closes out. That intervening period is a period of enormous amounts of risk. Token-based capital market activity compresses the settlement period, allows for instantaneous settlement, public incorruptible recordation of ownership. All of this is better for a healthier, more resilient capital market. The SEC chairman, Paul Atkins, the CFTC chairman, Mike Seelig, both understand this. The president has their back, and they're moving to tokenize the markets. And that's really exciting. It's exciting for us as a crypto company, but it's really, more importantly, good for the American people, because we'll have a better, more resilient financial system, and it'll help with the growth of commerce in the United States.
And second, the people fighting hardest against this are usually the ones with the most to lose. Traditional stock exchanges, legacy financial infrastructure, old market systems, they will say it is about investors' protection. And yes, investor protection matters, but let's be honest, it is also about control. Because if tokenized stocks become mainstream, it could challenge the way traditional exchanges makes money. It could challenge market hours, it could challenge settlement systems, it could challenge fees, and it could challenge who gets access to financial markets. This is why this matters. This is not just a crypto story. This is a power shift story. It is about who controls access to markets, Wall Street, or open financial technology. And historically, every time crypto opens a new door, the old system pushes back first. They pushed back against Bitcoin, they pushed back against Bitcoin ETFs, they pushed back against stable coins, and now they are pushing back against tokenized stocks. But the direction of travel is still the same. Finance is moving on chain, slowly, messily, with delayed, with regulation, with resistance, but it is moving. Now, I want to give you the UK angle, because most of the coverage is focused on America, but if you are a UK investor, this still matters. If tokenized stocks become legal and widely used in the US, UK regulators will be watching closely. The FCA, the Financial Conduct Authority, will not ignore a major shift in how investors access stocks, crypto platforms, and blockchain-based assets. The UK has already been exploring tokenization, digital securities, and crypto regulation. So if the US eventually moves forward with tokenized stocks, pressure could build for the UK to create clearer rules too. That does not mean it happens overnight, and it does not mean the UK will copy America exactly, but it does mean British investors should pay attention, because this could eventually affect how we invest, how we trade, how platforms operate, and how traditional assets move on blockchain. So if you are watching from the UK, this is not just an American story, this is your story too. Watch this space closely. So to bring it all together, the SEC was reportedly preparing an innovation exemption that could allow crypto companies to trade tokenized version of real stocks. It was expected around the week of 18th of May. Then, after pushback from traditional exchanges and market participants, the plan was delayed on May 22nd. The market reacted, Bitcoin dropped, Coinbase fell, and uncertainty returned. But this idea is not dead. Tokenized stocks are still one of the biggest trends in the future of finance, because once stock can move on blockchain rails, once markets can become faster, more global, more accessible, and potentially open 24/7, there is no going back. The SEC delaying this does not change the direction. It just means we wait a little longer. And the real question is, will you understand it before the rest of the market catches up? That is why I make these videos, so you are never caught off guard. Now, I want to know what you think. Do you think the SEC made the right call delaying this? Comment yes or no below and tell me why. I read every single comment. And if you want me to do a full breakdown on how tokenized stocks could work in the UK, comment UK below and I will get that video made. Make sure you are subscribed, because next week I'm covering something that could affect every single crypto holder in the UK directly. You do not want to miss it. My name is Lamia. Thanks for watching, and I see you in the next one.